I'm going to teach you how to hunt the hunters today. Hey, what's going on, guys? This is going to be more of an educational, technical stream. So basically, if you're someone who's struggling in the market, getting your butt kicked, you're constantly stopping out, and then you find out that the price just runs anyway in the same direction you wanted it, that's normal. So let's find out why that happens. Let me get my face minimized a little bit, and I'll walk you through what we saw on Target. It was the result of a member who reached out in DM, has been finding a lot of success lately, and just kind of wanted my thoughts on it. So here's my analysis. So just as a common sense approach, you just got to look at it at a glance. Does it look bullish? Does it look bearish? Does it pass the sniff test? Okay, so in this case, it looks bearish, right? We see the price is going down. And we got this big gap to the upside. It's not resolved yet. That's okay. They don't always fill, despite the claim that they always do. They don't always. So urban legend. Anyway, so basically what we have here is a bearish sell-off followed by consolidation, which is a flag. This is treated as a flag for all intents and purposes. Flags can break up or down. Typically, they default in the direction of the impulse. But let's see how that was taken advantage of. So first and foremost, I am bullish on this, and I'll show you why. So at the end of the day, high time frame, this is all we had. We had impulse, and then we're kind of range locked. Okay, we have this level here, and we have this level here. Price is kind of bouncing around between them, right? That's what most people are going to recognize. You can trade off the support. You can trade off the resistance into the channel, and that's what the institutions are doing. And let's walk through exactly what they did. If we look at the 30-minute chart, you can see that we have an inverted head and shoulders here. And obviously that's resolved because it broke over this high. Now we're forming a higher low and a push to the upside on a shallow retracement. So if you don't know what any of those words mean, that's okay. I'll kind of walk you through the common sense and the logical approach to this rather than the terminology, okay? So basically, just understand this is a difference. It's a reversal in trend strength. We went from forming lower lows, lower highs to higher highs, higher lows, okay? So that indicates there's more bullish sentiment. If we look at the 5-minute chart here, we can see this clean impulse from today. And then we have a fair value gap right here. And again, that's just a unresolved price action. It's a good opportunity for price to turn around. However, this is on the upper half of the impulse, so I don't really like it. I typically like these a little bit lower. But it is what it is. It's a strong move. Okay, so let's get all this out of the way, and I'm just going to break out the 4-hour time frame because it's a nice big time frame. We can look at stuff nice and objectively, and we don't need the extended hours on and all that good stuff. So just trying to make it as simple as possible. So we still have the overall trend here is to the downside, right? Big push to the downside, and we're kind of accumulating, right? We know as retail traders like you and I, it doesn't matter how much money you have, you're still a retail trader unless you work for an investment firm and you have, billions at your disposal. They know where we're likely to trade. Okay, we identified these levels here. We're probably going to try to trade this range. Okay, that's what most people are going to try to do. It just makes sense. Okay, until one of these breaks, then we're going to trade it to the upside or to the downside. Okay, it just makes sense. All right, so within this, we can identify areas where people are being taken advantage of, right? And that's all the institutions do because we're retail. We don't move the price. We're just a little drop in the bucket. And then we have the institutions on the other side of it who have billions of dollars at their disposal. They determine where the tops and bottoms are. They determine where people suffer, okay? And that's a key, that's a critical concept right here, okay? So if I'm an investment firm or a big bank, right, and I want to participate, I need shares, okay? I can't trade 100 shares and have my boss be happy with me. I have to get thousands and thousands or millions and millions of shares. And I have to do that by finding areas of liquidity. And I covered this earlier in another episode, but I just kind of want to use this example because it's a little bit cleaner, okay? So if I'm a hedgie and I want a bunch of shares because I want the price to go up or down, I need to place multiple block orders. I need to place multiple buys in the same zone so that I can get filled over time, because I can't just put all my shares in at once and hope it gets filled, because every buy needs a sell and every sell needs a buy, okay? So in order to get a bunch of my smaller orders filled, I need a liquidity zone, okay? And a liquidity zone is just somewhere where there's liquidity. So in the case of, say, retail wants to catch a move off support, okay? The inducement is right here, okay? Off the support, there's a confirmation that the price is likely to push up off that level. Bullish traders, buyers are going to step in right here. They're going to put their stop loss right here, right below there in case they're wrong. and the price should, in theory, go to the upside, okay? But if I'm an institution, I need the price to come back here a couple times in order to get filled, right? So these buyers here will set a stop loss. These buyers here will probably trigger their stop loss, right? And this is the concept here that we're getting into. In order to release these shares, I need to make sure that they're not being held by these other buyers. I need to hold them, okay? Which means I need to get them to sell them. So if I'm going to push price just below that level, just to poke it down so I can shake them out, then I can buy all their shares. All these shares here become mine, and then I can release the price to the upside. And that right there is where I'm going to commit to my buy. Okay. And then my big institutional sell order goes down here. And then that's where we get like big momentum fall offs, right? So there's always a little bit of a buffer there. All right. And we can identify that in a few ways, but I'm going to leave this illustration up here. But one of the hallmarks that I like to look for is a small candle body and then a huge impulse. Okay. And we're going to see that here in a little bit. So from a market psychology perspective, okay, if there's a bullish reversal anticipated by the institutions, by the market in general, they want the stock to go to the same direction we do. They just have to add a couple steps so that they can participate and make money off it. Okay, so we're not wrong in our assessment than saying, oh, this is, you know, it's got bullish bias, right? That's why we typically encourage people. It's like once you identify the overall trend, once you identify the setup and the bias and all that good stuff, trade that direction and trade it only, because most of the time you're going to be right. The hedgies want the price to go in that direction. The problem is you get stopped out right before it runs, and that doesn't feel good. So we're going to fix that today. All right, so the price came down, right? And we know that anytime there's a top, there's a liquidity zone, right? Because this is a bearish inducement for H-shaped continuation right here. And all that means when I say inducement is it's just some area of opportunity where people are compelled to take a trade in that direction. Okay, so a bearish inducement would be right here. Okay, this is a bearish inducement because the setup here is that impulse to the downside, a pullback that's a healthy range, 50 to 61.8%, and then they're looking for H-shaped continuation below this low right here. So this is a retracement play. Okay, so the inducement is right here, and the stop loss or the liquidity, in this case it's the buy stop order because it's a short sell. The buy stop is right here, which means if price comes back up here, all the people that shorted these shares that still have them are going to have to buy their shares to cover. Okay. So this is a liquidity zone for another move to the downside once the price comes back up to this level. All right, so that's an important concept. When there's a high formed right here, this becomes a liquidity zone. And we'll get to that in a minute. This one is already expunged once it hits this level right here. All right, they already filled that. So we'll talk about that in a second. All right, same thing to the downside. If, you know, there's a level right here, say a support level, and people want to buy and all that good stuff, the hedgies know their stops are going to be right here. So if the hedgies want to participate, they're going to have to dip into this range, get everyone to trigger their buy stop or their sell stops, and then they're going to have to buy those shares as they're being sold so that they can push the price back up to the upside. Now, in this case, this was the level and this was the sell side sweep, and sell side sweep just means that people are selling here. They want to buy. It's a sweep. They just sweep up those shares, they take them, and then they release the price to the upside. So we're not going to look at that sell side sweep. We're going to look at the overall push-pull of the market. So in this scenario, we have two institutional participants. We have the bearish one, which we'll look at first, and then we have the bullish one, which wants to trade this overall reversal. Okay, the bearish one is just looking for this specific move, and I'll walk you through exactly how that's set up. Okay, so in this case, right, price comes down, price comes back up. Okay, somebody stepped in, they bought, price went up. They decided, okay, I'm going to start accumulating shares here for another bearish push down because we need to resolve some price here, right? There's a gap here. You get a fair value gap. There's all kinds of unresolved price action down here in this range. So this becomes the area of target. Okay, and we'll just keep that in mind, right? This is where the bears want it to go. They want to resolve this price action before they release it back to the upside. All right, so price goes up, price comes down. As soon as the price starts to come back down, they know that shorts are going to step in, and this becomes a bearish inducement because all their buy stop orders are going to be on the other side of this level to the upside. So as soon as price comes back up here, they're going to have to buy their orders, and the bearish institution is going to sell those, right? They're just going to sell the same orders. This is a buy side sweep, and then they're going to release the price back to the downside down to this target level. Okay, and that's all they did. They're just looking for that short-term move just to resolve this price gap. And every time the price turns around right here, okay, off this level, In this case, it was actual sweeps. We don't have to worry about that. So, but in this case, there was just the one, right? One opportunity. There's a bullish inducement here. We'll get into the smaller stuff later, but for the sake of keeping this simple, understand that people shorted right here in this box. They shorted off the support. They wanted the price to go down to resolve this price action. It didn't resolve it. Instead, it formed a slightly higher low. The hedging needed the price to come back up here so they could so they could short more shares so that they could run the price all the way down here into that zone and then prepare for the bullish move to the upside. So this is now resolved right here, and I'll get into that in a second. But just understand that this is an inducement. This is something that compels people to take a position in that direction. These are the people that get taken advantage of, okay? This is the hedgy move. This is where they raid those stops. They take the shares, and then they release the price in the direction it wants to go for a bigger, more meaningful move. Okay? So once we have the bearish situation out of the way, then we have to look at the bullish, right? Because remember, this is the overall move that they really want to do. Okay? We know that the likelihood of it pushing up to pursue this high is much higher, and we have all these fair value gaps right here, which need to be resolved. Right? So this one here is resolved now. Okay, so that's where we got the opportunity there for that bearish confluence to the downside. Okay, confluence just means one or more setups aligning to achieve an end result. So, so if we look at this in terms of a bullish hedgy, okay, knowing that there's a low right here, there's a level of support formed right here, and we want the price to go to the upside. Okay, what are we going to do? We need to accumulate shares off the support and maybe below it, so that we can participate and then release the price to the upside. And that's what we're seeing, in my opinion. Now, every push off this level here, okay, is a bullish inducement because they want the bullish traders to be able to buy the shares, take their shares, and then release the price to the upside. So that's all we're seeing here, right? So buy order, buy order, buy order, stop, right? So the hedgies are going to level up right here, right? They're going to take all those shares. They're going to fill their positions, their big positions. And you can see this volume is massive right here on this wick. And then they're going to release the price to the upside up into this terrain, right? Or higher, okay? Now, that's all we saw. Sorry, that's all we saw because that was the bigger move, right? We couldn't see that before the bearish price was resolved down here into this gap. But that's what we saw here now, after hours, because we're looking at the bullish institutional view, right? There's bearish and there's bullish. So the bearish one is resolved. Now the bullish one needs to resolve. Okay, this channel could still break out to the downside, but at least we understand right now, based on specific factors that we can see, that there is in fact a bullish institution supporting this level. It's a strong level. It's supported. They want the price to push up off this level. And one more specific thing that I want to point out is that when we see these inducements and the sweeps, right, when they set up traders, retail traders to fail, and then they take their shares and act on them, we almost always see this configuration, right? Tiny candle body and then a large body. And the large body is because this is how they get filled, right? When we see the small body, that's them accumulating shares. They're absorbing the impact of the move in that direction. They're consolidating, they're accumulating shares as they're matching orders, and then they release it by putting a final order in by shoving the price in that direction, okay? So if we look here, all right, this is the inducement for the bear side, okay? So again, the bearish retail was here. This right here is what I'm seeing. I see a small candle body and then an impulse, okay? So that's our confirmation in these cases. That's what I always look for, all right? And from the bull perspective, okay, I see a small candle body, that wick, and then I see a massive impulse. So this right here is the hedgy move. So we can confirm that there is an institutional participant right here supporting this level. Okay, that's why I'm not too worried about this level failing at this point. Okay, it may still, like I said, there still might be another bigger institution just waiting, or maybe this is some sort of weird higher time frame manipulation. But at this time, this institution has a bullish thesis and they're supporting it with their money. Okay, that's all I care about. So retail knows what's going on. They try to trade. They get taken advantage of by institutions. Institutions take their money, they take their shares, and then they release the price to the upside in that same direction. Retail beats themselves up. They're like, oh, I knew I should have held. It's going to run anyway. That compels them to compromise on their stop loss next time, which leads to bigger losses and cheaper shares for the hedgies. So it's important to keep the psychology in check also. But for right now, we know one thing. We know there's a hedgie here, and we know there's a hedgie up here based on the same thing, right? So that's really all we have to look for when we're looking to not be taken advantage of. And if you're someone who's constantly trying to day trade, especially on the lower time frames, if you're on like the SPY 1 minute, for example, if I kick that over here really quick, you can see we kind of walked through it this morning. We had this trend line set up here, and then we had institutional support right here. This is a buy side sweep right here to the downside, okay? And that started here, right? Same combination with the candles, increasing volume, and then they allowed the price to go up and then slammed it back down as they got filled. Small candle, big impulse, small candle, big impulse, right? Same exact thing, increasing volume every single time. It's very methodical. It's very easy to identify once you practice it. And more importantly, you're not just jumping in because the rest of retail is or because you see a level holding. You're waiting for that institutional confirmation and you're trading in that direction. And you can see the same thing here, right? People who went long here put their stops in place right below this level, right? I'll just drag that over. This is where they put their stops, which means when it's time to raid for shares to go long, guess who's going to jump in? It's going to be the hedgie. So we can identify if we look at this, if we look and see increasing volume, right? This is abnormally increasing volume. Tiny candle body, big impulsive candle, right? And the price went up. And then they had another buy side sweep right here. Remember, liquidity is right here for the shorts. They slammed the price down. And right here is where the institution really stepped in, right? Tiny candle body, large impulse. And they let the price go right back down. And again, people that went long here have liquidity right here. They grabbed the price and they slammed the price back up to the upside. People that shorted right here have liquidity here. So it's just it's a nonstop cycle of waiting for the institutions to reveal themselves, right? So think about it like a sheep and a wolf, right? You've got a sheep, that's the retail. They don't know what they're doing. They kind of get a general sense of where things are likely to go. They've got a little bit of a structure to follow, which is good, right? We want that. We still want to understand things, because those do apply really well to larger time frames, but you can't feed a sheep everything, right? They have to be stressed out sometimes. Okay. So that's all they're doing. They're following the sheep around and they're acting like little wolves and they're taking advantage of them, knowing that the sheep are going to keep returning to the same areas, the same water holes, the same fields. They're going to keep trying to chase that grass and water so they can stay alive, so they can grow and all that good stuff. That's what retail is trying to do. They're trying to survive. They're trying to grow. Institutions are just sitting in certain areas, just waiting for those sheep to show up. And as soon as they do, they're hurting them. They're messing them up. They're messing with their psychology. They're putting them in compromising positions, and they're taking their resources. They're taking things from them. Okay, for the sake of not getting too graphic, they're essentially biting the hell out of them. So all we have to do is just not get bitten. And if that boils down to letting the other sheep go in front of you and using them as bait, waiting for the wolves to pounce, the institutions, and then waiting to see where the wolf runs off to, and then following that wolf. That's the way to do it, in my opinion. It's not to try to jump in front of things. It's not to blindly buy levels or guess at levels. You could see here, if you were a bullish trader and you just wanted to trade inducements, you could absolutely trade engulfing candles and you'd be successful a lot of the time. But if you're looking for the bigger, more meaningful moves, or if your analysis just doesn't seem like it's working out despite you doing everything consistently, chances are it's just because there's a hedgie sitting there waiting, knowing exactly what you're trying to do, and he's messing with you. It's his job to make you stressed out, take your money, take your shares, and you just keep doing it. You keep giving him stuff. So it's time to break that cycle, and this is how you do it. You just identify what you would normally do. Right? You look for your setup that you'd normally trade. You'd look for the entry you'd normally take. You'd look to figure out where your stop loss would normally be placed. And then you think about it like a hedgie. Where would an institutional participant mess somebody up if they took this trade? Where would I put my stop loss? Where do they need to acquire shares in order for this setup to fill itself out? Okay? And then once you do that, your mindset will change and you'll be like, oh, this sucks for everyone else, but I'm going to make money. Or I'm going to protect myself, because they're either going to dip into that liquidity zone and blast it, or that liquidity zone will fail. Either way, you're not in position until you confirm that there's an institution right there doing exactly what you need them to do, which means you don't put that risk on the table if you don't see a hedgie. And if you had bought anyway, and that liquidity zone fails, you would have just stopped out anyway. So there's really no disadvantage there. right? You're just keeping yourself reserved for a bigger move. The only losing case scenario here is if the price just runs without you being in it. And that's okay, because that happens all the time across the market. There's hundreds and thousands of stocks that just run every day and you're not in. You don't beat yourself up over those. The only reason you want to beat yourself up over the ones that you would have entered, woulda, coulda, shoulda, is that you weren't in them. And the hindsight, the end result, is dictating your feelings. Because that stock could have just as easily fallen down. And you wouldn't feel the same way. You'd feel, oh, okay, I missed out on that risk, so I don't have to realize that loss. It's okay. So keeping your emotions out of the mix is part of it, but also understanding your emotions, your impulses, your inducements, and the fact that there are predatory institutions that want to take your shares and your money, and being able to look at their hunting grounds and see where they're looking to take advantage of people and taking advantage of them instead is hugely empowering, and it's very profitable. So if you're struggling, practice this, study this. It's good stuff. Worst case scenario is that you just don't trade as often and it's okay, right? Remember, the goal here is to look at the volume as that's coming in, as it sell. If it's getting constantly bought back up in big gaps, like it's doing one of these numbers, it's like boom, like that's what you're looking for. You're looking for that aggressive buy up. That's an institution right there. And then if you have that small body followed by big body off a level of support right below everyone else's stop losses, knowing that they're screaming at their monitor right now because they stopped out and the price is likely to blast, that's when you get in, right? So there's always a joke that if you just took the average retail trader and did the opposite of what they did, you'd be rich. It's not wrong. I mean, 90% of retail traders wash out within the first 2 years. This is why. They get frustrated. So let's break that cycle. I'm going to end this right here. I just wanted to really walk through this example, kind of peak and valley at a time, so that we can demonstrate this concept of liquidity and how to get your mindset right. And then mainly just identifying where the institutions are, because they want to take your money. They want to take your shares. They need to in order to participate. So let's stop feeding them and let's go alongside them and take their scraps. So everyone have a good day. It's 22 and a half minutes already, so I ramble a lot, but hopefully you guys are getting some good value out of this. Feel free to study this as long as you want, as much as you want, and just understand that things make sense when they make sense, and you might have to watch something over and over again. That's okay. It might take 1,000 times for you to have something click. That makes the other 999 times worth it. So make sure you follow, subscribe, and then that way you'll get the notifications for these videos when I put these new episodes up. And if you'd like to, you can click the like button and all that good stuff, but that just helps the videos rank higher on YouTube. I'm not trying to profit off of this. I'm not making like sales pitches, and this isn't my living. I just want to help as many people as possible. So the more you guys engage on these videos, it does help other traders because it'll pop up on their algos, but it's not necessary. So I appreciate everyone's support, and I will see you guys next episode. Bye.